Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment at the MarketSite studio in Times Square, we have Phil Mackintosh, chief economist at Nasdaq. We're going to discuss why the market is interpreting bad news as good news. Phil, it's great to see you as always and to have you back on Trade Talks. Let's talk about September for a moment. It was a September that we don't want to remember.
But September was the opposite. September was good news for the economy, it was bad news for the markets. I mean, everything came out a lot stronger than we thought in September. It gave the Fed a reason to get back on stage and say, you know what, we're really going to focus on inflation, because it just, you know, as car inflation came down and oil inflation came down, rent inflation went up, and it was just all keeping inflation elevated, and the whole world was having the same problem. So the whole world was hiking interest rates and talking about crushing inflation, which generally does tend to lead to recessions, which made everybody worried about the markets.
Now we flash forward to the first week of October, which we're in right now, and we saw what the first 2 days did. We had a reversal from, you know, the lows of this morning. This is where it feels like bad news is good news, because the data is starting to come in a bit here.
Yes, so we had some weakish unemployment numbers. A lot less jobs out there for people to get, which is great, because Powell's been worried about wage inflation being part of the sort of lagging impact coming into the inflation numbers. If there's less jobs out there, we start to see employment soften, there'll be less pressure on wages, and so we might actually see that come out of the inflation story. And lots of other parts of the inflation story are looking better too, because the inventory has all come back and recovered. The supply chain seems to have mostly resolved itself, and so now you've got a lot of retailers talking about discounting, which of course is deflationary. So there's a lot of things in the last couple of weeks that's been not so good for the economy, but good for markets. Good for markets because things are slowing down, which is what the Fed needs to happen to see inflation coming down so they can take their foot off the gas. And the amount of interest rates that the market is expecting to see in the next 6 months is still pretty high. I mean, a lot of the charts you see, we're halfway there, which seems hard to believe considering how many rate hikes we've seen and how big they've been. If we can even halve that extra half, that's going to make a massive difference to valuations and just to how much the economy needs to slow into next year.
And we can see that on your next slide here, where that data is starting to come in and why the market is interpreting that as good news.
Yeah, I mean, all the things that we've been talking about, the supply chain really has started to fix itself. And so the cost of inputs, the cost of transport, oil prices are coming down. There's a lot of places where it really looks like inflation's falling, even though top line inflation's not actually falling that much yet.
Right, and to wrap up here, you had mentioned jobs before, and that really was one of the things that was propping up the economy, that one data point that was positive that everybody was turning to.
Yeah, and the data point that we put in this chart is something that the Powell at the Fed has been talking about, which is there was 2 jobs for every 1 person looking for work. And so when that's kind of happening, I mean, a lot of people were saying, even if he slows the economy down a fair bit, even if it gets to 1 job for every 1 person looking, that still doesn't create unemployment. And so we could have a soft recession because of that. But to see this softening is net a positive sign, because at the moment there's a lot of places that still can't restock labor and service the sort of consumption that now we want to do now that COVID's mostly gone.
Right, and this is something that you and I have spoken about before, that even though you hike interest rates, it doesn't mean that the situation resolves itself overnight. And I think sometimes there's that disconnect that the market is not the economy and the economy is not the market. The market is going to react much faster to these headlines and policy shifts than the actual economy will.
Yeah, in fact, there's some research that shows that rising interest rates can take up to 2 years to actually slow inflation. It tends to slow the economy much quicker, but to your point, it doesn't slow it instantaneously. You've got to see interest rates go up enough that companies are like, you know, I don't think I'll do that investment, or I don't think I'll hire these extra staff, and then that sort of trickles through into less income, less spending, and everything starts to slow down. So the market is much better at seeing the news and realizing what's going to happen in the future and pricing that in.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.